Today, I'm going to reveal something I've never shared before. My biggest portfolio positions, but more importantly, I'm going to show you why these positions matter and how to understand them could potentially transform your financial life too. Now, you might be wondering, Felix, why should I care about your portfolio? Well, let me put it this way. Our trading teaching portfolio is up over 80% this year alone. That's $24,000 on a $30,000 teaching portfolio. And today, I'm going to show you my long-term investment portfolio, which is partially funded by my trading portfolio. But before we dive into the nitty-gritty, I want to introduce you to my secret weapon. This is Winston, my adopted golden retriever. He may look like just another adorable furball, but don't be fooled. Winston here has a nose for sniffing out the best investments, and in fact, he's the one who dug up most of the research for what we'll be discussing today. So let's get down to business. We're going to explore the top 20 positions in my long-term portfolio, and I'll also explain why each of these made the cut. In addition, I'll also show you my growth portfolio. But remember, this isn't just about mimicking my portfolio, it's about understanding the principles behind these choices so you can make informed decisions for your own investments. At the top of my list, we have Microsoft, making up to over 12% of my portfolio. But why Microsoft? Well, I'm not just fond of Excel spreadsheets, though I am, but it's because Microsoft exemplifies what we look for in a quality stock. And that, my friends, is the key to our strategy. And if you're wondering what our strategy looks like, plus you actually want to get the data in a Google sheet you can look at and study yourself, just go to felixfriends.org/great and download the full list of these stocks, plus my historic portfolios, plus the actual rules that I implement. It's completely for free, felixfriends.org/great. As I always say, we look neither for value stock nor for growth stocks. We look for quality stocks. But what makes a quality stock? Well, it's not just about the PE ratio. In fact, I pretty much ignore PE ratios. Instead, I focus on three key things: profitability, cash generation, and financial stability. Let's break this down. First, profitability. We look at metrics like gross margin, operating margin, and return on capital employed. These tell us about the company's efficiency, cost control, and management effectiveness. Next, cash generation. We examine cash conversion and leveraged free cash flow margin. And these basically reveal a company's ability to turn profits into cash, a crucial factor for long-term success. Now, if some of these terms mean nothing to you, that is completely understandable. They mean nothing to most people. I've actually put out a free 6-hour-long course on YouTube, and I shall link to that at the end here so you can enjoy that. In fact, I'll also put it down below in the description, and that way you will be able to fully understand everything that you need to know to become a great success as an investor. Finally, we look at financial stability. We assess leverage, which is borrowing, and interest cover. And these metrics give us an insight into a company's financial risk, its ability to weather economic storms. Now, you might be thinking, Felix, this all sounds great, but how do I apply this to my own investments? Well, I'm glad you asked. We're hosting an exclusive live webinar where Winston and I will dive into our trading strategies, which in my view will also make you a better long-term investor. So if you want to understand how we trade, what our rules are, how we set up the automations for that, then head over to felixfriends.org/webinar and grab your free spot. But let's get back to our portfolio analysis here. So after Microsoft, we have in place 2, Meta at over 6%, followed by Stryker at 6.8%. Now, you might be surprised to see Meta here, given recent controversies, but remember, we're looking at a long-term potential, not short-term noise. And if you look at the amount of GPUs the large companies are stockpiling, Meta is at the top of the list there. So if you think there is money in AI, I actually think Meta is probably the one that everybody's underestimating. Now, let's dive deep into each of our top holdings. Understanding these companies and their moats is crucial to grasping our investment strategy. What's a moat, you wonder? It's the thing that makes that company be able to fend off the competition. What makes it hard or expensive or unlikely for their customers to not switch to a competing product? So let's start with our largest position. Microsoft, over 12% of our portfolio, is one of our cornerstone investments. It's built a moat on a vast ecosystem of products and services, from Windows to Office to Azure. Microsoft has created a network effect that's hard to break. But what really excites me about Microsoft is its cloud service division, Azure. In an increasingly digital world, cloud computing is the backbone of innovation, and Azure has been showcasing phenomenal growth, consistently gaining market share. This isn't just about storing data anymore. It's about powering AI, machine learning, and IoT. And Microsoft is positioning itself at the heart of the next tech revolution. Next up is Meta, formerly known as Facebook, at almost 7%. Meta's moat is its massive user base across Facebook, Instagram, and WhatsApp. The network effect here is enormous, and Meta's data-driven advertising model remains incredibly powerful, and with AI, is going to get better and better and more profitable and more profitable. And I had a funny conversation the other day with somebody in WhatsApp about the country Aruba, where that person was. I have never talked about Aruba in my life. I've never written the name Aruba in my life. And guess what? About 30 minutes later, I open my Instagram account and I get an advert related to Aruba. So Instagram, WhatsApp, Facebook, clearly reading the data and what you're doing, and they're sharing that. Scary, yeah, perhaps, but from an investor's point of view, it's rather clever, isn't it? Next on our list is Stryker Corp, almost 7% of our portfolio. It might not be a household name, but it's a powerhouse in the medical technology field. Stryker's moat lies in its innovative medical tech and strong brand reputation among healthcare people. With an aging population, demand for Stryker's orthopedic implants and medical equipment is likely to grow. But it's not just demographics driving Stryker's potential. Their focus on robotics and AI and surgery is pushing the boundaries of what's possible in medicine. And this combination of current demand and future innovation makes Stryker, to me, a compelling long-term hold. Next, we have Visa, making up over 6% of our portfolio, a company that benefits from one of the strongest moats in the business world, the payment network effect. Every time you swipe your card, Visa's moat gets a little stronger. The cost for merchants to switch away from Visa is prohibitively high, creating a strong barrier to entry for competitors. But Visa isn't resting on its laurels. They're pushing into new territories like peer-to-peer payments and blockchain technology. And as the world's increasingly going cashless, Visa is positioned to benefit enormously. Next, we have IDEX with a double X, IDEX Laboratories, at 6% of our portfolio. And again, that might surprise you. These guys are leaders in veterinary diagnostics. I literally have my cat lying next door who's feeling a little under the weather. She has a UTI. Guess how they found out? They did an IDEX laboratory test. And these guys are the ultimate leaders in vet diagnostics. Now, why pet diagnostics, you might ask? Well, let me tell you a little thing about the pet care industry. It's booming. IDEX's moat is its dominant position in this growing market, with pet ownership on the rise and people treating their pets more like family members, as they should. They're probably better than most family members. IDEX specialized products and services are in high demand. They've also built a strong recurring revenue model through their diagnostic equipment replacements. And it's a perfect example of a company with a strong moat in a growing market. I like it. Next, we have automatic data processing, or ADP, again at 6% of our portfolio. What's the moat? High switching costs. Once a company integrates ADP's payroll and HR systems, it's incredibly difficult and costly to change providers. But ADP isn't just about payroll anymore. They're leveraging their vast trove of employment data to provide valuable insight to businesses. And in a world where data is increasingly valuable, ADP sits on a goldmine. The expansion into workforce management and HR analytics position them, in my humble opinion, well for future growth. Now, this next one might be a bit controversial, but hear me out. Philip Morris International. At just under 6% of our portfolio, it has probably the strongest moat in the consumer goods sector. Brand loyalty is the official line, but the reality is a little different. Advertising for for tobacco products is illegal. Therefore, no competitor will ever enter the market again. Because how would they find their customers? They can't advertise. And then we got Philip Morris with their Marlboro brand, recognized worldwide after decades of advertising. And yes, smoking rates are declining in many countries, but Philip Morris is pivoting. They're heavily investing in smoke-free products like IQOS, and that isn't actually a defensive move. It's opening up new markets and revenue streams, and there are definitely massive ethical considerations. These guys, in my opinion, are pushing smoke-free tobacco products on children, which is not a good thing to do. But from a pure investment point of view, Philip Morris has insane cash flow. The dividend yield makes it attractive, and well, they buy back their own shares on top of it. So I would be very, very happy to be one of the last shareholders of Philip Morris, because I think they're going to keep printing money. Like addiction, ethical issues, advertising is illegal. It almost makes you wonder if the big tobacco companies thought, wouldn't it be amazing if nobody could ever compete with us? And we got politicians to ban tobacco advertising. Think of the money we'd save. And we'd never have competition again. Right? Conspiracy theory number one of the day. Now, next, we've got Waters Corporation at just over 5% of our portfolio. It's a company that operates a little behind the scenes, but it is crucial to many industries. Their moat lies in their specialized analytical instruments used in laboratories around the world. And they're not just any old instruments. We're talking about high-precision tools used in drug discovery, in food safety and environmental testing. And the barriers to entry in this field are enormous, given their expertise and reputation. As regulation around drug safety and food quality becomes stricter globally, Waters is well positioned to benefit. Next, we have Marriott International, making up 5% of our portfolio. It's basically a bet on the future of travel and hospitality. Their moat, brand recognition, and their loyalty program. In the hospitality industry, trust is everything, and Marriott has built that trust over decades. Now, what excites me about Marriott is not the sort of low 5-star, upper 4-star category that they're in. Yes, I'm a hotel snob, but it's how they're adapting to changing travel needs. They're expanding into the home sharing market to compete with Airbnb, while also focusing on the luxury experience for higher-end travelers. And as global wealth increases and travel becomes more accessible, Marriott is poised to capture a significant share of this growing market. Last in our top 10, but certainly not least, is Alphabet, Google's parent, at just under 5% of our portfolio. Google's moat is its dominant search engine and the vast amount of data it collects. This data advantage fuels its highly effective advertising platform. But Google is also much more than just Google Search. They're leaders in AI and machine learning. They're pushing the boundaries with their moonshot projects, and they're sitting on a huge cash pile that gives them the flexibility to invest in future tech. From self-driving cars to quantum computing, Alphabet is positioning itself at the forefront of a lot of tech revolutions. Now, you might be wondering how we identify these companies and their moats. Well, that's exactly what we'll be diving into in our completely free 6-hour course. If you want to watch that, check out the link down below. I'll link that down for you. But but what about growth stocks, you ask? Well, we treat those separately. They're more challenging and riskier to pick, but they can offer substantial returns if chosen wisely. For growth stocks, we focus on high operating margins, strong revenue growth, low debt, and a large target market. We also look for companies where the CEO or founder is heavily invested. After all, if they believe in the company, why shouldn't we? Some of our top growth stocks positions include Tesla, SoFi, Nvidia, and each of these companies has shown remarkable growth potential, in my opinion, and aligns with our criteria for quality growth stocks. Now there is a secret ingredient to our success. Are you ready for this? The secret to our success is patience. That's right. Patience. As the great Warren Buffett said, time is the friend of the good business. We don't just buy good stocks, we hold them for the long term. Think about it. How many times have you sold a stock only to watch it skyrocket months later. By holding quality stocks for the long term, we give them time to weather short-term volatility and realize their full potential. But remember, this strategy only works with quality stocks. As I always say, you can buy a good stock at the wrong price, provided you hold it long enough. If you buy a bad stock at any price, it'll never give you a good return. So how do I keep adding money to this portfolio? Every Monday. Seriously, every Monday I buy stocks, and I typically buy the same basket of quality stocks, and then I will do maybe some tweaking to the growth stocks when there are more wilder swings, and then I also trade maybe 2 hours a week or so. The trading profits go back into the main portfolio. Now, I know we've covered quite a lot here today, but we discussed our top portfolio positions, the metrics we use to evaluate stocks, and our approach to growth stocks. But there is so much more to explore. And if you want to dive deeper into this, learn the principles so you can apply them to your own portfolio, then there are two things that I would urge you to learn. One is learn the short-term income strategies that I use for trading. For that, join our live trading seminar coming up next week at felixprehn.org/webinar. And then once you have a little bit more time, maybe on the weekend, save the video that I'm linking to at the end, which will be that 6-hour investing course. And that'll give you a really, really, really deep understanding into actually what matters. I think both things are kind of equally important, because how much money you make with your long-term portfolio depends largely on how much money you put into it. And how do you put more money into it? Well, if you can make your money work for you so you don't have to, then life becomes a heck of a lot easier. And remember, investing isn't just about making money. It's about securing your financial future, achieving your dreams, and gaining the freedom to live the life on your own terms. And with the right knowledge and strategies, you can take control of your actual destiny. So you ready to transform your investment approach? Are you ready to join the ranks of informed, successful, educated investors? Then don't wait. Click on the links I put down below. And until next time, this is Felix and Winston wishing you happy investing and even happier returns. Winston and I are super excited to have slaved away for about 3.5 months to record this. Endless hours of editing it. And 3 years studying economics, working in a bank and everything else, and actually giving you a free course